Hello, and a very warm welcome to all of you to the London School of Economics and Political Science for tonight's public event, Blended Finance Needs to Scale 10 Times, Can It, Will It? My name's Tom Gosling. I'm a professor in practice here in the Financial Markets Group at LSE, where I'm director of the initiative in sustainable finance, and it's a pleasure to welcome you all to the Sheikh Zayed Theatre. Tonight we mark the formal launch of the LSE Blended Finance Lab, funded by the LSE Global School of Sustainability. Before we start, as normal, a couple of admin matters. Please make sure your mobile phone is on silent. For those of you who post on X, the hashtag for today's event is hashtag LSEBFL. This event is being recorded and will be made available as a public video, subject to there being no technical difficulties. We also have a photographer here to capture the event, and a selection of photos will be published on our website. So if for any reason you do not want to be in the images which may be published, please do let one of the LSE people know after the event. There's no fire drill scheduled for today, so if you hear the alarm, please leave the building following the guidance of our staff. So this evening we'll provide a brief update on the work of the Blended Finance Lab so far, and then with an esteemed group of panellists, we will consider the question, blended finance needs to scale 10 times, can it, will it? And as usual, will be the chance for you to put your questions to the panellists, and I'll let you know when we open the floor for that. But first we'll hear from Lord Stern about LSE's Global School of Sustainability and why blended finance is a topic of interest to us. So I'm now delighted to invite Lord Stern to the podium. Nick, please do come up. So Lord Nicholas Stern is the IG Patel Professor of Economics and Government, Chair of the Grantham Research Institute and Chair of the Global School of Sustainability and Head of the India Observatory at the LSE. And I already feel quite tired having run out that list. I don't know how you do it, Nick. He was knighted for services to economics in 2004 and appointed a Companion of Honour in 2017. And he's published more than 25 books and 200 articles. His new book, The Growth Story of the 20th Century, The Economics and Opportunity of Climate Action, will be published by the LSE Press as an open access publication, and the launch of that is going to be on the 5th of November. I don't know if there's any particular significance or symbolism around the day. Nick, we would welcome some context from you for our discussion on blended finance, given your chairmanship of the Global School of Sustainability and your long-running interest in development finance. Thank you, Nick.
Thank you. And it's a real pleasure, but it's a celebration today. We're celebrating the launch of the Blended Finance Lab. And my task, it's not a burden, it's what I want to do, is to show how that fits in with the overall story of sustainability and the Global School of Sustainability. The Global School of Sustainability was started in January of this year, and I'm the chair of that, and we like to think it was co-founded with myself and Lei Zhang, and Lei is a wonderfully valued alumnus of the LSE, who did a lot of good in the world and made some money whilst he was doing good in the world. In this case, wind turbines, solar panels, the running of those things. And he felt he wanted to support the study of sustainability and the transformations associated with sustainability at the LSE. On the grounds, correct in our view, that most of the problems now to the transition that we have to make are in the economy, society and politics. And it's a supremely international story. So we're better than the London School of Economics, particularly since that's where he came from. So that's what the Global School of Sustainability is about and where it came from. It helps to have a definition of, you can have a Global School of Sustainability, you ought to have some idea of what sustainability means. So this is the working definition that we use, that it offers to the next generation opportunities at least as good as this generation, on the assumption that that generation behaves in a similar way to those that follow. Slightly different from earlier ones, which some of them have talked about needs, but we talk about the opportunities. Well, what shapes the opportunities of the next generation? It's the endowments that this generation offers to the next generation. What sorts of endowments? Well, physical capital, the infrastructure and the buildings, human capital, the health and the education, the natural capital in our forests and our lands and our oceans and so on, and social capital, which is what kind of society are we? Do we function? Are we cohesive? Do we trust each other? What kind of inequality is in there? All that social capital, in the good sense that it supplies services and it can be built, and of course it's particularly easy in that case to destroy. So those are the four capitals, those are the endowments that we offer, which shape the opportunities of the next generation. That immediately takes you to, well, then the story of transformation and the story of avoiding catastrophe is about investing in those capitals. Now, we focus often particularly on the physical capital side, but absolutely not only on the physical capital side. It's clear that we have to talk about our natural capital. I've already indicated essentially why we have to talk about the social capital, and clearly the human capital is about health and education. We can, through the pollution is associated with the deaths of 5 or 10 million people a year, out of a total number of deaths per year, a little bit more than 50. That's big. And most of the of that pollution comes from the burning, not all of it, but most of it comes from the burning of fossil fuels. So this is then, as soon as you say that this is about sustainability, as soon as you ask what the obstacles are, as soon as you ask about what it means, you go straight to investment. Now, if you start to look at how much investment, I'm not going to go into all the numbers, others will do that, but you're talking about, to make the kinds of transformations we need to make at the speed we need to make them, you're talking about an extra 2 or 3 percentage points on investment across the world, and keeping it that way for a couple of decades. Perfectly feasible. We've been at higher levels of investment in the past, but you have to be active to make that happen. You have to create the conditions for that kind of investment, and it's going to be bigger in the emerging markets and developing countries, and the big story of growth and investment will be in those countries. So starting off with a simple idea, we've immediately got a task. How do you create the conditions for the kinds of investments we need? And particularly in this case, how do you create the finance for the investments that we try to lead? So there's a logical path which goes straight to the blended finance story. And right from the beginning, the whole idea of blended finance was one of the first things that we wrote down when we had discussions with the donor about what this whole thing should look like. The Global School of Sustainability has a number of research themes. I haven't got the time to go into them in detail, but essentially the 5 areas are economy, finance, law, behaviour and institutions, and the natural capital. So we try, through those research themes, to cover the broad areas of investment in the different kinds of capital that I've just described. We've got scholarships and we have research grants. But today we're talking about the Blended Finance Lab and celebrating its start. So what are the sources of finance? I've already emphasised the conditions of finance, the conditions for investment, and we have to keep emphasising the conditions for investment. And they have to be created by the country, and they can work closely with multilateral development banks. And we've got people who are running multilateral development banks with us today, and a few of us have spent a good fractions of our lives working in those banks and international institutions. They can help with the conditions for investment, and they can help with the finance. Now let me close by emphasising the key sources of finance. Now in most countries, at most times, investment is financed through domestic savings. Of course, we live in a world with open economies, and that's good, but still, most of investment is financed through domestic savings. And the mechanisms for doing that are extremely important in this whole story of blended finance. And the public finances are extremely important in doing that. If you want to borrow to invest, then your public finances that are looking after domestic government expenditure have to be in pretty good order. I believe Rachel Reeves was trying to explain that to the Labour Party conference this afternoon. But it should be blindingly obvious in the language of John Cleese. If you want to borrow, then you've got to have a secure set of funding for the government expenditure you're talking about. And if you want government investment, then investing some of that out of government revenue, even though you should borrow as well, is a good part of the story. So domestic resource mobilisation, public and private. And that means looking, of course, also at the domestic capital markets. The next sources are, of course, external. And I'm doing them in rank order of importance in relation to this big volume of investment. The domestic resource mobilisation, biggest, then external private, then the multilateral development banks and development banks more generally, and then concessional finance. So those are four big areas. Those are the four big areas we're talking about blending, and we're blending for a purpose, which is to fund the investment in a way that's accessible and affordable. And the challenge then is how you do that. And so we've gone from the story of what sustainability is all about straight through to the centrality of blended finance, and then the kinds of blends that you're going to need will depend on the kinds of investments that you want to make. Basically now, electricity generation with renewables is funded by the private sector, and good. You know, it's fairly mature, you know what you're doing. Restoring degraded land, not so easy to get that funded by the private sector. Challenge, of course, the Blended Finance Lab. Let's try and find ways. Let's see if we can do better than we're currently doing. But inherently, it's going to be more difficult. A lot of adaptation investment, even though it has fantastic returns. You know, roughly speaking, you know, you're talking about $1 of adaptation investment saves you $10. This is big returns. But that $10 is sort of distributed around the people who are not being flooded, yeah? And it's not so easy to raise that in the private sector. So a key part of this whole blended finance story would be the recognition of the whole range of investment that we need, making sure that the local domestic resource mobilisation is functioning and being helpful about that, but then, of course, bringing the blends that are going to make it accessible and affordable. And, of course, the cost of capital itself is critical. And the cost of capital depends on the risk, and the risk is exactly the kind of thing that you're trying to manage and reduce and share appropriately. So this is a really big agenda, and the Blended Finance Lab is at the heart of it all. That's why we should celebrate. Thank you very much.
Well, thanks, Nick, for a really excellent introduction, perfect introduction to our proceedings this evening. I'd now like to just share a brief update as to what the Blended Finance Lab has been up to, because although this is sort of positioned as a launch, we've been a bit sneaky and we have actually done some work in the last few months and we're underway. But I think the first question to address is, why do we need another initiative in blended finance? All right? There is not a global shortage of initiatives in blended finance. The reason really is this, which is that we live in a time where the Sustainable Development Goals are falling further behind each year. I mean, set for achievement by 2030, we're probably even optimistically 20% on track to meeting them. And the funding gap is probably of the order of $4 trillion a year, of which $1 trillion needs to come from the private sector. Set against that, blended finance, a term coined in 2015, but it's obviously existed for a very long period of time, was seen as a promising way to close the gap and by strategically combining public and philanthropic capital with private sector capital to mobilise large-scale funding. But nearly a decade on from that initial coining of the term, blended finance transaction volumes, according to data based on from Convergence, were around between 15 and 20 billion dollars. So really vastly below the scale that's needed. And often conferences on blended finance conclude with the conclusion that we need more blended finance, but not always with the pathway to how to achieve that. And so blended finance could be positioned today as promising in theory, but underperforming in practice. And so through the Global School of Sustainability and the capacity and resources that has created, LSE has decided to take a serious interest in trying to close that gap. And that is why we've launched the Blended Finance Lab. And we do recognise the excellent work that is done by many initiatives in blended finance, and our aim is to complement them rather than to compete with them. And we will be, actively figuring out exactly where our point of differentiation is. But we believe that as a preeminent academic institution, we have convening power, we have research assets, we have strategic understanding of the development finance agenda, and to some degree, we have the luxury of time to think about issues which is not always available to market participants. And we believe that these assets can be used to help the market move on in the blended finance agenda. It's also fair to say that we don't have a fixed mandate set by somebody else, and so we're free to deploy wherever we can be most effective to support the blended finance ecosystem. And that gives us a certain independence and agility, which we believe can be very helpful. So what have we actually been up to? I'd like to invite Harald Walkate to the stage now, and we'll give you a bit of a flavour of the work of the lab. Harald is a senior advisor at the LSE Blended Finance Lab, and he's a founding partner of Route 17, a blended finance advisory firm, together with his co-founder, Robert van Swieten. And the two of them have been helping us to establish the lab. Robert sadly can't be with us today. And we've been working since late March, early April on establishing the lab. But Harald, perhaps you could first just briefly introduce yourself and Robert.
Sure. Thanks, Tom. It's great to be here. Thanks, everyone here. It's, as you say, we've been working on this half a year, but really this is kind of the official launch, so it's very exciting. Harald Walkate. I founded an advisory firm called Route 17, together with Robert van Swieten. Both have long backgrounds in financial sector and development finance, also corporate law, and took an interest in blended finance many years ago, recognizing the importance of the tool, and a couple of years ago decided to focus on this in particular, and that's why we launched Route 17. So we advise basically on blended finance, but also more broadly the partnerships that are needed for this type of funding.
And of course, having seen it through your professional career as an investor, the difficulties of putting these blended finance deals together. And in that context, the funding gap that I talked about kind of makes it obvious why we call this event Blended Finance Needs to Scale 10x. And arguably, we could have called it 100x, and we had a bit of a debate about that. But what is it that you think is preventing blended finance from scaling?
Well, there's a number of things. We have a nice slide on it. So this is something that Route 17 developed a couple of years ago. We were invited to organize a symposium with Dimensional Fund Advisors, the asset management firm, to explore exactly that question. And so this is a slide that we put together. It's kind of very high level, and there's a lot of detail behind all of this, but it summarizes it nicely, we think. So first of all, often there's just a lack of investable projects. And actually I should have explained, but you might have seen, so we call this the mobilizing private capital equation. And we kind of liken this to an amplifier that has dials where you need to turn the different dials to actually get more capital out. We like using music analogies. And so this is also sort of the idea of if you want more music to come out of your machine, you need to turn up these dials. So the first dial is actually having projects to invest in. And that is actually is not as easy as one might imagine to kind of develop more of these projects. Then there's also, so blended finance is basically the use of concessional capital or risk mitigating capital, often used by development banks, but could also be by other organizations that are willing to use sort of concessional money. But that isn't always used as much as it could be, and it's not always used as effectively as it could be. So that's another dial you need to turn. And then what is also very important is blended finance is basically bringing together of public and private capital, philanthropic could also be, which also requires there to be sort of an effective marketplace. And so what we've called here a private sector, or DFI, private sector links. Often the parties that are required for these types of transactions don't really know each other, or at least don't work together. And so that's also something that we need to address and have more of a marketplace. Actually, in many ways, that's also what we're trying to do now with the Blended Finance Lab. And then finally, the private investor orientation. So there's often sort of this assumption that private investors, pension funds, insurance companies, and so forth are also interested in making these kinds of investments. So often there's substantial interest in impact investment, for example. However, these organizations aren't always sort of organized for them to be oriented to this type of investment. And so that's also something that needs to be addressed. And all these things to some degree are sort of holding up the flow of capital. And we need to kind of twist all these knobs to get more out of it.
So, I mean, there's been quite a lot of analysis done on the impediments to blended finance, and I think many of them would, although they might kind of position it differently, actually agree with your diagnosis here. There's probably a common understanding that these are some of the kind of weak points, but how have we decided to set up the lab to go about addressing this and actually, at LSE, making progress towards solving some of these problems?
Yeah, so what we've done specifically, I guess you could sort of call the backbone of the lab, is we have a number of work streams. So there's also recognition, obviously, that we have all these different actors in society or in financial markets who need to make a contribution, play a role. So there's governments, there's DFIs, there's asset owners, there's also asset managers and banks, then there's NGOs and foundations, there's academics. And what we have done is sort of proactively invite stakeholder groups or people, organizations in these stakeholder groups to apply to join one of these work streams that we've set up. So the idea is very much to bring them together and have conversations with them individually. So that's also what we've been doing part of the day, having separate work stream meetings to make sure that we understand which specific issues are pertinent to those particular stakeholder groups. But obviously, we also want to use those work streams to then sort of mix them up and facilitate conversations or collaborations where we think that that is actually feasible or is going to lead to more investment.
And Sven, one of the things that we got asked sometime when we set it up initially as well, given that blended finance is a multi-stakeholder issue, why are you setting up separate stakeholder groups? Doesn't that defeat the purpose? But our observation of certain convenings around blended finance was that actually if you bring everybody into the room together at the beginning, actually you get an incredibly broad conversation that can be at cross purposes and actually not a lot tangible is taken out of it. So by starting with the individual work streams, what we've been doing is trying to assess and identify what for them as a particular actor, critical actor in the orchestra, what is it that they need in order for blended finance to scale. And then we can identify from those issues, firstly, where can LSE really make a difference? Because we're in the business of making a difference, not on focusing on areas that other people are dealing with perfectly well. But it also means that when we have a particular issue identified out of one of these work streams, it quite likely will need convening across multiple work streams really to solve it. But we can do that in a very focused and intentional way based on those particular topics. And today, during the day, delighted to say that of the 75 people who signed up to the work streams across those different constituencies to work with us, we had 50 of them here today working throughout the day in those work stream meetings, from which we've taken an enormous amount of insight that I haven't even half processed yet. And in addition to that, we had a group of people who are connected with the blended finance ecosystem who joined us for a session just before this one. And just to give you an example of the type of issue that can bubble out, from our dialogue with asset owners and asset managers earlier in the summer, there were two issues that came out. One was that for asset owners, they just don't know what bucket to put blended finance in, right? It's this thing that appears and they just don't know really how to use it or interact with it. And so we've commissioned some early stage research on how to think about blended finance in the context of an asset owner's asset allocation model and strategy, because if you can't unblock that, you don't really pass go. The second issue that came up in a number of our work streams was the problem around rating blended finance projects. Most blended finance projects do not have a credit rating. That immediately blocks out large groups of institutional capital. So again, we're doing some work on actually what are the key reasons why blended finance deals don't get ratings, and what are some of the issues that actually donors are going to have to address. Maybe they're going to have to think about the conditions that they put on blended finance deals. Perhaps we're going to have to think about intelligent ways of aggregating blended finance deals to overcome this ratings question. So that's just giving you a flavour of how we're trying to go from be educated by the ecosystem of actors in blended finance into very specific tangible projects where we believe we can make a difference. And as we develop the lab over the coming months and years, we will also be connecting that with the work that we do at a much more strategic level in LSE around connecting with finance ministers on the broader blended finance agenda. So we're hugely excited and enthused by the amount of engagement that we've had today. We're really delighted that you're here. I'd like to really thank everybody that's helped get us to where we are to date, so particularly you, Harald and Robert, but also those that have contributed to the day and the work of the lab so far, so Nick Robbins, Lauren Ashbury, Milagros Urtasan, Pranav Kandinya, as well as the support provided by Anne Law and Ulrika Ruth-Taylor. Really delighted for all the help that you've given us. Thanks very much. Harald, thank you for helping me with that intro. I'd now like to invite our panellists to come to the stage. I don't have a particular order, so I'll go here, and then if you come, Odile, why don't you come round in here? José, if you go next. So thanks very much for joining us up here. And so for this panel, we've established a very senior and experienced set of leaders from the global finance industry to help us explore what practical challenges are needed to be overcome, practical changes are needed for blended finance to achieve global scale, and how really to move from theory to measurable impact in this area. I'm going to introduce them briefly, but they have extensive CVs, and I'll refer you to the conference information for the full details. But if I could introduce Odile Renaud-Basso, who is the president of EBRD, the Bank for European Bank for Reconstruction and Development. José Viñals, he's a special advisor and former chair of Standard Chartered Bank, and also, I'm delighted to say, an LSE Council member. Hans-Peter Lankes, who's the managing director of ODI Global, an independent global affairs think tank based in London. And Luiz Pereira da Silva, a former Deputy General Manager of the Bank of International Settlements and former Deputy Governor of the Central Bank of Brazil, who's now focused on international development finance issues, including here at LSE. I'm going to pose some questions to the panellists, but there will be an opportunity for Q&A later on in the session. I'll let you know when that's coming, so do please think of questions that you want to ask our panellists. But José, I'd like to start with you first, if I may. So Standard Chartered is a key player in blended finance transactions around the world. And that gives you this really exceptional view, I think, into the marketplace. And it really is about financial market structure that I'd like to ask you. And experience with financial markets tells us that for markets to really scale, we need to have integrity and transparency of the market. We need to have liquidity with buyers and sellers and intermediaries. And we need to have a degree of standardization of contracts. And we could argue that blended finance has none of those things today. It's largely a private market. There's little transparency. There's not much of a secondary market. So is it any wonder that blended finance transactions are way below where we'd want them to be? So first of all, I'd say, do you agree with this analysis, or is it too pessimistic? But if so, how do we grow that blended finance marketplace in order to unlock more blended finance transactions in both public and private markets?
Okay, well, first of all, thank you very much, Tom, for having me on these panels. And I found your words, Nick, as always, very inspiring. I think that this is really a very important mission, the one that the school has, and I think it's really a source of inspiration for everybody in this room to think in the way that you have done about these matters. Now, on the blended finance, I will speak, based on my experience at Standard Chartered, which, as you said, is very involved in blended finance. Standard Chartered, we have a very extensive footprint in throughout Africa, Asia, and the Middle East, covering many emerging markets and developing economies, but also we sit in the main international financial centers in the United States, New York, in London, Singapore, and Hong Kong, the 4 largest international financial centers, which is where the money sits, and then the money needs to flow where it sits to where it's needed. And what it's needed mainly for sustainable development is in emerging markets and developing economies. So we play this super connector role, which is so important and which is actually commercially interesting proposition for us. So it's not just the right thing to do, but it's also the smart thing to do from the business point of view. And blended finance plays a big role in making sure that the two things are aligned. Now, blended finance is not just about pooling resources. It's about pooling experiences and pooling different things that the different players bring in. And I think that this is what makes it very unique. It's not just a combination of private money and some sort of public money, catalytic money. There are lots of experiences that come together. And I can tell you, in a number of the projects that I have been closest to throughout developing economies, I can tell you that I've seen the beauty of blended finance in practice. But you're absolutely right. It's beautiful, but it's piecemeal, it's ad hoc, and hasn't been scaled up. So it doesn't solve the collective problem or helps solve the collective problem as much as we would like to do. And every blended finance project is a big effort. You have to roll up your sleeves from the beginning. You have to bring together quite a number of parties. You have to make sure that you're well connected, for example, in the role of an international bank, with the domestic authorities, with the multilateral system, also private insurers, which are interesting here. And you have to understand very, very well the local situation in order to be able to identify well the risks that need to be the risk, and then make all these international connections that allow the risk to be the risk, so that you can get to a bankable project in terms of the risk-return equation working out. And then when it happens, you see the impact, and it's wonderful, and it's also profitable. So it's just a win-win, but it takes tremendous effort to put forward. So what's needed? The bad news first, the good news later. The bad news is that don't wait for a magic bullet. There is no single thing that you can do that can scale up blended finance 10 times. But there are a number of things that together can make a huge difference and take you to where you want to go. And I would like to think of 5 or 6 things which are important. One, which I think is close to your first sort of dial, Harald, has to do with project preparation and the pipeline of projects. That's extremely important. The World Bank, based on the experience of the Global Infrastructure Facility, something I'm sure you know very well, has sort of looked at the data and concluded that for every extra dollar that you put on project preparation, you can get out of 276 additional dollars in terms of project finance. When I first learned about it, I said, well, I must have read something wrong. Maybe there is a point here, is 27.6 or 2.76. No, it's 276. So this is extremely important, project preparation, number one. Second, transparency. We have no good data to track the performance of, in terms of default rates, in terms of recovery rates, of blended finance projects, but more generally of infrastructure projects and project finance, which is so critical for sustainable development. And that is very important, because if you don't get this exposed performance, you cannot provide a data that helps, for example, the credit rating agencies perform the role the best that, or as well as they could be. It's also very important for investors because sometimes when you look at this historical data, it's better than people think, so the perceived risk is higher than the real risk. And I think it's also relevant for regulators, which sometimes need to reconsider how to recalibrate some of these risk weights in order to avoid unintended consequences. So data transparency is very critical. But the transparency, I think, is also important in terms of what is blended finance. There are many people in the investors community which just don't know about it. They need to understand this better. How do I engage with it? How do I access it? What is it available? What are the key actors? I think there is a financial education role, and here we are at a higher education institution, which is extremely important. Number 3, standardization. For a market, you need certain, you mentioned integrity, transparency, we've talked about them. You need standardization. This is a bit more complicated here because you would like to create a particular asset class. There may be several, but there are certain templates of things that have worked well in the past and that can be used in order as a reference point for blended finance structures to be created. I think that these templates or archetypes, they're often called, are extremely relevant. And I think it's also important, standardization is something that our friends from the multilaterals do, which is the guarantees. If you're an international bank, you have to go through a spaghetti bowl of guarantees which are different here and there, even within an institution like the World Bank. No longer they get unified, but if you work across different MDPs, it's a mess. So standardization. 4th, move from project finance to pools, to packages, to programs, critical. Institutional investors don't want to invest in a project in Angola for water sanitation. We do that, and we can get that done. But institutional investors don't want to put their money, okay? But they want to invest in pool of assets which are reasonably standardized, which can be rated, where there is a senior tranche which has investment grade rating, and they're willing to invest in that. So that packaging is key. 4th, foreign exchange risk. Very important. It can be done. There's certain things that, for example, EBRD is doing, things we're doing with the IFC, which allows for local currency to be provided to local markets to finance projects, so there is no mismatch. And last but not least, financial regulation, and I already covered a little bit. Very important for banks, but very important for institutional investors like pension funds and insurance companies, which sometimes may be subject to some of the unintended consequences that need to be explored a bit further.
So you're talking about things like Basel and Solvency II.
Well, I think basically that's what it is, but it's also the way that Basel recognizes the guarantees or the credit risk mitigation instruments of multilateral development banks or DFIs, which sometimes, I think that there are things that the DFIs can do in order to see if within their legal structures they can tweak their contractual terms in order to fit better into the Basel framework and get full credit, or so that they can be the risk, the project, or if sometimes there is a need to adjust a little bit the regulation in order to better understand how things work in multilaterals without losing at all the primary focus of financial regulation, which is to provide financial stability. But subject to that, there are things that can be improved.
Thank you. Does anybody want to add to or comment on what José said? He covered it extremely well. Odile, I'd like to come to you now. I mean, EBRD is expanding its operations deeper into Africa, a continent where, as we know, many balance sheets are strained of both sovereigns and private companies. How can we use blended finance in the optimal way to get the private sector from the global north to invest at greater volumes and with more impact into Africa's economic future and development?
So indeed, we are starting to invest in Africa, and this will be an area, a region where we will need very much blended finance in order to. But maybe to start about how, as an MDB, we see this issue of blended finance, which is an EBRD as quite a unique mandate in the sense that we are very much private sector focused. And I mean, more than 75% of our investment are in the private sector, supporting a private sector counterpart, which in a way is, with a big objective of bringing our own balance sheet, but also mobilizing, co-investing with private investors. In a sense, I think there are two levels of private mobilization. The first one is being able to bring private investors co-investing with us without providing them concessional funding, so without providing any guarantees and so forth, but in a way, the project preparation work we are doing, so a lot of resources invested in defining the regulatory framework, looking at the parameters of the project, providing technical assistance to the client to develop the project and so forth. All these create a quality of project which make it more investable, make it more bankable for private investors, but without bringing guarantees, without bringing concessional funding, especially to the project. And on that, we are really, there is a big trend of increasing what we are doing in terms of mobilization and moving to, changing the model of MDBs, moving to originate to distribute, which is doing more projects, increasing the pipeline of bankable projects, and then rather than keeping the project on our balance sheet and selling them to the market, selling them or finding ways to share the risk with the market. And that is an area where, all MDBs, mostly working in the private sector, are willing to do that and exploring ways to do that with different structure with the market. And there, on this, we still need to work on the scalability and on the standardization, because even if we bring transaction like 500 million of project, we package a bunch of loans, 50 loans or 50 projects, this is not enough for the market. We need to even scale that up, at a bigger scale. So that's one big range of issue which I think is in a way part of blended finance, because it's the way to scale up and bring private investors at a bigger scale to finance projects. There is another dimension which is more restrictive in a way, which is using donor money, concessional funding, in order to reduce the risk of project we are doing. And on that, this is something which is also very much needed in order to go beyond the risk limit we can take, to be able to push the boundaries and take risk, more risk and projects which we could not finance otherwise, thanks to this concessional funding that will allow us to go beyond what we would do normally. And on that we do, on infrastructure, but also in a lot of funding for SMEs through banking system, but being able to provide concessional funding either in the form of technical assistance and so forth to the ultimate client, so as to ensure that they can, they have increased their probability of being successful, have a stronger impact on the client, the ultimate client, but also a lot of portfolio risk sharing where we can take part of the risk, but we need sort of the backup from donor funding in order to be able to do that. What is complex in the process, and I very much like, the different tune you need to, button you need to scale up and in order to make it smoother, is that you have, on the one hand, we work, MDBs, and I think development in general, we work based on project and in a country and in a given environment. We are trying to move away from that, for example, working a lot on country platform, on programmatic approach, where you bring together a broader scope of project and not only client by client. The second constraint is that we have donors or being on the public sector, government funding, or foundation, philanthropy, which are very much willing to know exactly what they want to finance. They know they want to be closely involved in selecting, I'm ready to support this project, I'm not ready to support this project. The solution, I mean, the development of global funds like the Green Climate Fund or CIF has helped moving forward, moving beyond this approach or more on a more programmatic approach, but it's still very challenging to have the concessional funding on a sort of big scale for a big program and so forth. And in a way, what we see is more and more scrutiny from donors on what they want to finance, what kind of client, what kind of suppliers, what kind of country, and so forth. And this makes the matching between project, concessional funding, and so forth much more complex. And this brings us to very ad hoc solution where each time it's very complex and time-consuming to match what we are, where we can leverage concessional funding so as to have blended finance.
Sorry to interrupt you there, I just wanted to follow up on that point around specific donor requirements, because that's something that came up today during our discussions. And so do donors need to have be prepared to make greater compromises or have a greater degree of pragmatism about what they ask for as the price for scale?
Yes, I think that if you want to have a bigger volume scale, in order to bring private investors at a larger scale, you need to have program, and then donors need to commit to say, okay, I'm ready to give a first loss guarantee or to provide for a big transaction that would bring together a number of projects, and not look at project by project with a high level of uncertainty where finally they would go for it or not. And that is becoming more complex, I think. So for example, the EU, they have some blended finance project where they provide guarantee for third countries or even for within the EU, but becoming now willing to look more and more at each of the projects. So that, I think, is something where there is a mismatch, I think, between the ambition and the reality of how things operate.
Sorry, I interrupted you. I think you were going on to say something else. Had you finished? Sorry.
I think I can stop here. But
carry on.
No, I'm fine.
You sure? Okay. Sorry, I was just aware that I'd sort of jumped because I was really interested because that had come up during today. So Hans-Peter, maybe I could turn to you now. And so Leslie Masdorp, who's the CEO of British International Investment, BII, so he wrote in LinkedIn late August, I don't know how closely you follow his LinkedIn feed, that the development finance system is faced with a new set of conditions which calls for the design of a new global development architecture. After the initial phase of despondency following the dismantling of US aid, we are now firmly in design mode to craft new financing approaches and business models to adapt to the harsh new reality that governments across the industrialized world will be fiscally constrained for the foreseeable future. Do you agree with this sort of fairly sobering geopolitical assessment? And what new financing approaches and business models may be in the offing, and does a greater role for blended finance fit into that, with private capital necessarily playing a bigger role in global development?
Yeah, thank you, Tom. First of all, I do agree, and it's simply factual, what Leslie is describing there. But I want to sort of add a dose of opti-pessimism there, because there's change in two ways. One is that we're being hit by this brutal cut down in ODA, which US aid is kind of the most visible, and then a big chunk of the OECD has followed suit, a bit less dramatic, but they have followed suit. So we have, and it started before the new US administration came in. It started last year. So last year there was already a decline on the order of 8 to 10% of ODA. This year, I think OECD estimates that there will be another 10 to 15%. By the end of this year, we will have seen a decline by 1/4 of official development assistance. That's something on the order of $50 to $60 billion a year less in flows. And then there will be some knock-on effects, even if it stops there, knock-on effects through international organizations, World Food Programme and others, that are going to be starved further down the road. So that's a brutal hit. And it is a hit on the poorest countries. And it's important to note in our discussion here today, it's a hit on the poorest countries. ODA recipients are the poorest countries. These are not middle-income countries. They are low-income countries, fragile states, etc. And it is a hit on certain sectors. Strongly, the health sector. USAID was by far the largest donor in the health sector, in social protection sectors, in emergency assistance, in education. It is in the social sectors, broadly speaking, that we're seeing the biggest hit. And for many countries, it's a significant proportion of their GDP. So in the poorest countries, we're talking about 2, 3, 4% of GDP, and a very significant share of their public, of their budgets that is going. At the same time, we have also, predating this year, and for some time already, seen a fairly significant increase in development finance. So that has been growing, particularly over the last 5, 6, 7 years. We've heard it from Odile, and has been equally fast at this point. So just a couple of weeks ago, there was a report presented to the G20, which is now being done annually, on how the MDBs are implementing the recommendations of the G20 capital adequacy framework working group. So essentially recommendations that were meant to allow MDBs to grow their balance sheets. And it's a fairly optimistic report. So this one comes out saying that about $650 billion in additional lending capacity over the next 10 years have been created by measures that the MDBs have taken over the past 2-3 years. And that brings them from something on the order of $120 billion a year in lending 2019 to 180 and more today. And that is growing further. It's coincidentally is kind of the same number, as the cut in ODA that we're witnessing. But these are very different groups of countries. Much of the increase in development finance is going to middle-income countries, partly simply because of capacity. Low-income countries do not have that absorption capacity, but also in terms of the growth rate that we're witnessing. And it goes into investment, it goes into general government, it goes into other types of sectors. So it does not replace the loss of ODA. It does not, it's not a safety net for the low-income countries in particular. So it's important to see these two developments. Now, on top of this growth in development finance by the MDBs, we see this shift, very strong shift over the last 2-3 years towards the mobilization of private capital. I've been witnessing this for years, having sat in these institutions. We've been sort of going since Addis, since the declaration on billions to trillions. We have been, sitting around $20-30 billion annually in direct mobilization by the MDB system, some 60-70 billion indirectly, and it hasn't really changed much over almost 10 years. And then suddenly, over the last 2-3 years, it started to accelerate. And now we see, say, at the IFC, where I worked last 2021, IFC mobilized $12 billion from the private sector directly. This year, it looks like they've mobilized 40 to 50 billion. That is a brutal shift. And the EBRD is doing that, and IDB Invest is doing that, and the other MDBs are doing it. So we're witnessing this shift. And those numbers, as we heard from Nick earlier, they are going to be very important in filling the overall gaps in financing for climate, for development. We're expecting from the private sector, the second largest was after domestic resource mobilization, second largest contribution. And this is where the MDB system is contributing in mobilization. But that mobilization Blended finance has not played a big role in that growth in mobilization. Blended finance has been fairly flat. There's been some growth, I think, last year, according to Convergence, as Tom told us. But the year before, it came down, and it's been sort of going up and down. There hasn't really been much growth there. So it does not explain this growth in mobilization, and it's partly because of this focus on middle-income countries that we're seeing. And just to conclude on that, it's really important. Is there scope for blended finance to grow? It's important to differentiate what I call two strategies. One is an impact frontier market strategy. This is how do we manage to invest on private sector basis with private money in the poorest countries? How do we manage to invest in adaptation finance? How do we manage to invest in unproven technologies? That's sort of the impact and frontier segment. There is not much mobilization in that segment. We cannot expect large numbers, large volumes of private finance, of institutional capital from the north to go into those segments. And then there is the market, what I would call the market strategy, and that is where we've seen a lot of innovation recently, and there has been a growth there. It is about lifting institutional capital into these situations, and all those conditions that we talked about apply, the standardization, everything else. And that's happening. There's a lot of engineering going on, and that is growing. But those are two very different situations, and often in the debate, we mix those. Yeah? And it's very important to be clear that what do we want to push? What is it that we want to grow here? Is it the hard to reach, the ones that have just been hit by the Odile decline, the ones where the poverty sits, where the adaptation need sits, where we want to make that? Or is it the middle-income countries that are close to bankability and where a little bit of a lift from blended finance can bring the large numbers for the investments that need to happen there? On closing, one point here, which is we've talked about conditions for institutional investors to come in, for private capital to come in Asia. But there's also conditions for the public sector to make that concessional money available. And concessional funds, so the share of ODA that has gone into blended finance has been essentially flat. $2, $3, $4 billion every year. And having sat in the seat trying to convince ministries, development ministries, to allocate more to that, the point is that there is a lot of skepticism, and we have to overcome that skepticism. And part of that skepticism is, as José was saying, is the lack of transparency. There is an incredible lack of transparency. We don't really know as a public, and therefore as a taxpayer, what it is that we're achieving, what it is, how much is going in there, in what form. There's a lot of skepticism. We had to fight it with the US Congress at the IFC. Who blocked IFC's capital increase for almost a year, on those grounds, to say this is non-transparent. You're putting money into rich private individuals in these countries, and we don't know what we get for this. Right? So there, the industry really has to get better, and it has to get better. See my colleague Frédéric Dahan and Sam Ettridge, they've just come out with a paper demonstrating how little we really know in those decisions that we're taking on blended finance about the use, the minimization of concessionality, about the sustainability of these investments. Are they actually going, about the impact on the market into which these investments take place. So potential, but a lot of work required.
And I mean, on the face of it, that's not an unreasonable request, and Odile, you wanted to chime in.
No, I wanted to comment on the 2 points of the transparency in the level of blending and concessionality and so forth, because I think one of the big challenges is that blended finance comes with concessional resource. I mean, it comes from ODA, ODA. It will be more and more under pressure. And then, so we need to ensure that the allocation and the way blended finance is used is really allocated where it's most needed and with a minimum level of concessionality. And we tend to see sometimes because of the incentive or about showing volume and so forth, the more you ask for moving to trillions, the more MDBs are all willing to show some volume and so forth, and so there may be some competition on bringing more concessional resources in order to develop the project and so forth. So that's one element, and I think that's an element where the lab could be, developing a method. We have a common MDB methodology, but I think fine-tuning how measuring concessionality in the blended finance and the transparency around that would be very important. The other thing, I think, from the donor government perspective is that there is always a willingness for having recognition. You finance a project, you give some concessional funding, you want to be seen as participating and having the political recognition and so forth. And with blended finance, it's very difficult because you provide some support that will, it's very difficult to attribute to one donor this project where somebody can come, cut the ribbon and so that I think is one of the challenging of how you mobilize donor funding and concessional resources for that. There are probably way on the narrative and on showing the impact where this can be overcome. But
Thank you. Yeah, thanks. Fascinating. So, Luiz, you've had a really unparalleled view, really, on global macroeconomic development for quite a long time, both in your role as a Bank of International Settlements, but also in Central Bank of Brazil. Blended finance, at least in principle, holds great promise for aiding development in Latin American countries, and IDB's been doing good work there. But how would you like to see global blended finance develop? What are the structural impediments that we need to overcome? What can we practically do about it?
Yeah, I think in the developing world, everybody realizes that blended finance is a very essential, one of the instruments that would allow to finance the transition. It has systemic broad implications for developing countries. And obviously, it has to be scaled up urgently, because where the damage is done, where the necessity of investments against extreme weather events, for mitigation, for adaptation, this is where it is. I think we would all agree in the time. But put yourselves in the shoes of a developing country. Why is it that this is not happening? I mean, and if you put yourselves in the typical developing country government, he sees a lot of impediments from the political side today. What you mentioned about the reduction in ODA, it should be growing. The lack of willingness to increase the capital base of multilateral development institutions, which are the basis upon which you can enlarge the level of guarantees that would allow precisely to be a first taker of risk for blended finance. He sees a lot of completely gratuitous and sometimes even ridiculous political fragmentation, where even the notion of addressing climate issue is not recognized by big administration. Of course, I think I can safely say here that the attitude of the U.S. administration is just appalling on this. So this is what the developing world is seeing. So of course it's important to have this discussion here, to have, let's say, a round table where we put concrete elements to facilitate the scaling up of this type of instrument. But I think its urgency is the issue. Political will is definitely the issue here. And there are some good news. I don't want to be provocative, but there was a moment in history where the financial sector was capable of mobilizing in a couple of years trillions of dollars. Trillions. I mean, I don't want to be provocative. Some of you guys are too young to remember that. But, there was a moment where you had subprime loans somewhere that you could sort of pull together, package into very opaque, sophisticated products, that were originated in the, I mean, I'm not going to describe the GFC and the crisis, but I'm talking about just the technology. If the technology and the financial technology was used for evil purposes, for, let's say, speculative, short-term profit-taking purposes, if you look at the structure and if you look at the construction itself, the instruments, securitization, the capacity to create special purpose vehicle for investing and benchmarking green bonds, the creation of a system of guarantees that can be recognized by credit agencies, not simply in the short term, but rated much more for their long-term benefit. If you can, of course, instead of having opaque instruments, as José and Odile were mentioning, you need to have transparent green instruments that can be sort of very clear for investors that they have, as Nick was saying, a very high social return in the medium long term. They are investable. It's an asset class that is investable. If you marry all this, I'm not suggesting to recreate a green equivalent of the bubble of the global financial crisis. On the contrary, but you reverse and you use the instruments and the technology, adding to that some of the new features that we know artificial intelligence, smart contracts provides in terms of precisely creating the the foundations, the technical foundations of blended finance. I think there is hope for moving from a couple of billions to something that becomes a asset class of new investments that can even be considered by big asset managers, even by central banks. When I was at the BIS, we created a investment pool of green bonds for central banks to invest part of their reserves into this type of product. I'm saying this is the miracle solution. Again, there is no miracle solutions, but you add these technical elements based on the financial technology that we know exists and we know works, except that you put it to work in a positive way, more transparent, more clear taxonomies, more purpose for investments in these types of asset classes, the capacity to recognize that guarantees based on the capital of multilateral development banks are not just short-term, but they can extend to a long period of time. So you add up all these elements of a financial technology that exists, I think you can sort of begin to sort of consider a horizon that will sort of be in the eyes of developing countries, a perspective that they themselves will be very glad to embrace and to use with their own domestic development bank systems. I'm sure, Odile, you work a lot with many developing regional or bilateral development banks in the developing world that can precisely create this synergy. So again, we have the technology, we know how to do it, we are sort of in facing a very, very complicated political economy at the global level, but I think we can supersede this with partial coalition of the willing countries. We don't need necessarily to have unanimity in deciding some of these activities that I'm describing. You can perfectly define sectoral and partial regional collaborations with the multilateral development system and sort of begin using these financial technologies not for short-term profit-taking and speculative purposes, but for the global common good. This is what I hope.
Did you want to add something?
Yeah, I wanted to.
Thank you, Luiz.
I think these are very good ideas. And to add to the positive, which I think is important, and I think that the point that you brought in about low-income countries as separate from middle-income countries is extremely critical, and sometimes we bring them together. So maybe I can provide some granularity here. There is one element that I wanted to bring in together with a couple others in this conversation. One is the low-income countries, middle-income countries. The other one is project by project versus aggregation of projects. And the third one is the platform aspect, which are the JETPs, the Just Energy Transition Platforms. And this is something where instead of going project by project, you go at the national level. And something we haven't mentioned in this conversation is that, from the point of view of investors, the problem is, well, I cannot invest in this country because the policies don't create an enabling environment for me to come in. Well, maybe there's an opportunity for a win-win. If you change the policies, I bring the money. And that's what the JETPs do, right? If you think of the JETPs in Indonesia or the JETPs in Vietnam, I've been very involved in both of them. In the first, there is a commitment from a private sector sort of group of banks, G funds, of about $10 billion. In the case of Vietnam, 7.9, nearly 8. Okay, then there is some quid pro quo. We're going to commit to invest this, but there are things that are going to happen internally so that you improve your policies on the regulatory front, in terms of renewables, in terms of grid, whatever. So these things can be done. So that's one example. Now, for low-income countries, Lesotho. We have been involved in a JETP with Lesotho, the country that one famous politician didn't think existed or had never heard about it. I know about Lesotho. I have met with the authorities of Lesotho, including a very enterprising king who wants to do really good and wants to achieve energy independence because they have fantastic natural capital that needs to be used to provide renewables, rather than importing that and depriving the country of key foreign exchange that they need to do other things. So again, that's something where there are changes in the policy in exchange for commitments is important. There is also the JETP of Senegal. So there are some examples in low-income countries. I know this is a drop in the ocean, but there are some interesting examples. But I think that these aggregation mechanisms that take you from project by project into national structure, or even better, the sort of ABS structures that we have observed and we still observe for many other things, is very important. In the World Bank, the IFC just issued yesterday or a few days ago a 500 sort of million sort of CLO structure, which I think is the first in this category.
But José, the slight difference, the idea of using, of course, the balance sheet of multilateral institutions is great and is necessary. But investors, for example, central banks in the BISIP, the green BISIP, were taking BIS risk. They were not taking, let's say, developing countries' direct risk. And this is the challenge I think we are discussing here, is that at some point in time, of course, you can sort of translate and make the transfer through a multilateral body to have the funds into either a low-income country or a middle-income country and so on and so forth. But at some point in time, investors need to take direct risk into the developing country per se.
In the CLO, they take the risk of the countries, not or in the synthetic risk transfer,
exactly.
they take
So
the risk of
this is
the
where I think you need to accelerate the process so that you can create the risk, the de-risking process and the mechanism through which you will be able to have these flows directly channeled by taking exactly the direct country, the developing country risk itself. And it's not, I think we all agree, it's not easy, but this is, I think,
this
way...
World Bank structure, there are 3 tranches, and the MDBs are taking the IFC, the first,
the first loss tranche.
The junior tranche, and then the institutional investors take the upper piece, the senior tranche, which fits with the fiduciary responsibility. So I think what you're saying is an example would be what I'm talking about, but the important thing would be to do a lot more of this. And I think that this is something which hopefully we will see more.
Well, I mean,
about
we
in the
know
future.
asset under managers of big, large asset,
Sure.
it's 11, several $1 trillion, central banks, international
Hundreds.
reserves.
Hundreds of
thir-
trillion dollars.
Hundreds of
Hundreds of
trillions, $13 trillion. So this, if you have a tiny a portion of that can be mobilized precisely to be useful in terms of be a component of blended finance, that's what we are aiming at. And the sooner the better.
But so the puzzling thing there is that the risk is actually not higher than in OECD markets by various measures. So if you take the MDB DFI GEMS database, which is sort of a pooled risk database, has 20-something thousand individual observations at this point over many years. And there, the risk, say, of infrastructure investment is absolutely at the same level as in OECD countries. That may partly have to do with the fact that these are MDB investments, and MDBs, they structure their projects well and they
that's
stay
why
on
you
top of
need
them.
to adjust Basel III regulations precisely
Exactly.
on this particular.
So then comes Basel III
III
and does not take a risk-based approach. It just excludes.
I mean,
That's
come on,
what
I mean,
that's
if
the
you
point I
have,
wanted
if
to
you
make,
have
because
people
indeed-
meeting
No, no,
every
no.
other month at the Basel
No, that's
Committee
a point I
for
wanted to
bank
make, because
supervision, why is it that the decision cannot be taken?
on the regulation,
Tell
and
me.
we've been
Afraid of
discussing
the
that,
Americans.
when you look at the below, so when we invest, and the GEMS database show the risk, at a very low level of default and the very high recovery rate when we have any default and so forth. And we used to have quite a lot of financial institutions investing in parallel with us, so with the below structure. The financial crisis, I was thinking, the paradox is that it was for, what you call maybe more speculative, but then it has a negative effect on, because the regulation was much tighter and so forth, and then we saw the appetite, and because of the cost of capital and the regulatory impact for banks being very significant, and a very significant drop of the loan, because it doesn't reflect the real risk. And I think that's, so co-financing with MDBs, because we spend so much time in preparing the project, we have some preferred creditor status for some dimension and so forth, that helps reducing the risk. And then that could, but for the time being, it's not taken into account, and it's difficult to open it.
But this is critical, because unless we can provide the data and the evidence is sufficiently conclusive, we are not going to make the difference we want to make. And the GEMS database shows what you said. That's MDB lending. It shows that project finance and infrastructure finance is better risk in emerging markets than high yield corporate debt in advanced economy. So how can that be? And that the quality increases with the maturity of the infrastructure finance project. So there is a disconnect, but people say, well, but it's GEMS database, and there is a bit of a selection issue here because these are the sort of parties with which the multilaterals lend, etc. Okay, banks, we have the data, we have the micro data. If you ask me what's the evidence you know from your bank, just one, but operating through many emerging markets, developing economy, is the same. The risk, the actual risk is lower than the perceived risk. The perceived risk, which is rated by credit rating agencies, and the perceived risk, which is in the Basel standards, both the capital and the liquidity standards. So there is a disconnect. But we need to put this data together in suitably sanitized, semi-aggregate form so that it can be shared, and we can make the case that on the basis of the data, this doesn't make sense. And if you adjust regulation, that's a big roadblock that can be,
I love the fact that you've
The
made me completely redundant in this process by questioning each other.
The FSB and the G20 requested for a profound, thorough revision of the methodology of credit rating agencies. I think they are, in many instances inadequate. They are sort of not really reflecting what we were describing here, the granularity and the opportunities of investing precisely with blended finance in developing countries. They have some bias.
I would like to give the opportunity for members of the audience to ask some questions to our panelists. I love the way that the vitality and energy of that grew. This is obviously an issue that you all feel incredibly passionate about. If you have a question, please raise your hand. I'll probably take them in threes. And please state your affiliation. We always welcome as well, in particular, questions from LSE alumni and students. But also, please ask a question rather than making a statement, and keep it as brief as possible, and then we can get as many as possible in. Okay, the gentleman here, Sarah at the end there, and the gentleman there in the middle. So if we start with you.
So Aaron Kelschke, I lead impact investing at Invesco. So we manage assets of about 2.1 trillion for clients around the world. The question I have is that it almost sounds like we've been here before. I think about the Emerging Green 1 program, which was funded by the IFC with junior tranche at 250 million, which did scale to about 2 billion, and that was in 2018. And we think about public markets, private markets. We have 140 trillion of assets in the public fixed income market. We have about around 3 trillion of assets in the private credit market. What do we need to do in terms of getting investors to come from that public markets investment side, as was the case with IFC and the Emerging Green 1 program, across to the private market space? And I really welcome your thoughts on the public-private divide. Thank you.
Sarah Gordon, I'm a visiting professor in practice at the Grantham Research Institute here at the LSE. Such amazing insights from the panel. But I just wonder whether it resonates with you in your different spheres at all, that some of the research that I've done into the effectiveness of public and private investors working together is they are fundamentally collaborative partnerships. And I think we ignore too often the human relationships that underlie so many of the failures of blended finance approaches, instruments, funds. So often you get investors saying, oh, but they didn't share my investment approach, or they wanted too higher, the risk-return profile didn't make sense to me. But often it's actually about power imbalances, and I think some of that was referred to on the panel, but it's also about the need to build the trusting, collaborative relationships between very different actors coming from very different places with very different priorities. And I think we neglect that in terms of how successful, the challenge of scaling blended finance. And I just wonder whether that resonates with the panel. Thank you.
And the third question, the gentleman in the white top there.
Hi, thanks so much. Nick Rohani, CEO of Vula AI. We build AI systems for blended finance in Africa. What I wanted to know from the panel was, I think especially on the point that Luiz was making about the use of fintech in enabling more transparency, and everybody here spoke about the importance of actually collecting data and creating these common goods that all institutions can play in. What we see actually working in this market is that there is this tug of war between trying to maintain my own proprietary data to have an edge on the market, and then all of us collaborating to make this happen. Now, we have answers on the commercial side, but how do all of you actually see this playing out at a global scale to enable these trillions of dollars when everybody is trying to maintain their edge, doesn't necessarily want to put out transparency because it might show how ineffective some of their programs are, so they can't get the next donor pot of money or run the next TA program. But then at the same time, we need data on people's failures so we can learn. How do you actually see us navigating this as a world practically?
Okay, three fantastic questions. I won't ask you all to answer all of them, but perhaps, José, have you got a thought on the first question about what we need to do to get this sort of pivot from the scale of investment and financing that we've had in public markets into the private markets?
Well, I think that coming back to some of the things that we talked about, you really need to have. Funds are the way to scale this up, and for that you need at the other end institutional investors, and you have to make sure that whatever assets you design fit into the sort of risk-return, fiduciary responsibilities type sort of framework of the institutional investors. And I think that is a must, because otherwise you are not going to get the big money coming into what's needed. And in order to make these things happen, I think that, just linking a moment with the second question, the issue which resonated with me a lot, the issue of close collaboration between the private sector and the public sector, the partnership through innovative ideas. I can tell you, for example, how the conversations with the World Bank have evolved over the past 3 years from it's not possible, it's not possible, it's not possible, it's not possible, to, oh, why not? I think that that's critical, and that's exemplified in the creation of the private sector investment lab. So I think that this is something which is doable, but I think that the way to do it would be the funds or the funds of funds, and then tailoring them with the characteristics or standardizing them with characteristics which allow institutional investors like yourself and others to come in, because there are nearly $300 trillion of assets under management out there which are not coming into good investment opportunities once we get this blended finance providing the risk-return equation. And that's a real opportunity cost, which is costing lives. That's a problem. It's costing lives every single day. It's not just money and GDP, it's lives. So it can be done.
Does anyone, yeah, so.
No, I think one of the big components of that is, I mean, the part you described, José described, but also the capacity of generate the quantum of project which would be investable. And I think it's not, I mean, we are investing 16 billion a year, that's been increasing substantially. The IFC, I mean, World Bank is investing massively, but on public sector which cannot really attract, I mean, it's with very concessional funding, which is not, I mean, it's not the kind of risk return. So the private sector activity of the AFC, this is, can generate a lot of mobilization. But so this is also very much a dialogue with the countries, because the policies to be implemented, the ambition in the green transition, and so forth, all this is very much needed, so as to have the pipeline of bankable projects that can be invested in.
Look, I think if you are an asset manager or a pension fund manager today, there is an incredible change in the landscape and opportunities for you to precisely invest in green projects in developing countries. The US administration has been damaging the credibility of the safe asset in the financial global economy by a repeated number of actions, uncertainty, policy uncertainty, and of course erratic policies. And this of course is very bad for the global economy, it's very bad for the US, but you know, it's also a shift in terms of relative risks. If you are to invest into diversification of your portfolio into emerging markets. It's not that emerging markets, of course they should improve their policies for sure. I mean, if you look at my country, Brazil, for God's sake, we've been, struggling with this for decades. But at the same time, the relative risk between the US 10 years and what is the typical developing country bond has shrunk. And this is a reality. Now, whether this is going to be a sort of a global trend, whether this is going to be seized as an opportunity by large asset managers or not, this is, I think, up to precisely the discussion we're having to define what are the parameters to create a safer, better asset class that would be, and I'm not even talking about the sort of change in the global financial order with other currencies substituting the dollar, but at least a change in relative risk. I think this is what's happening.
Hans-Peter, could you pick up the question maybe on this question about whether we underestimate the role of human factors, power imbalances, and the importance of trust and collaboration in actually getting blended finance deals done?
Yeah, it's absolutely correct, and Sarah, I know your work has looked very closely into that, and it's very difficult to address. One thing we're seeing happening, though, is that over the years you have some institutional investors, Allianz, BlackRock, a couple of others, that have had their teams beginning to sort of specialize and learn the language and learn about the public sector, learn about the MDBs, You have on the side of the MDBs, over the past few years, you have the treasury departments have been brought into these jobs who are market-facing, who know the language. I think there is sort of a gradual, coming closer in terms of the culture that you have. But it is absolutely crucial. I have to say, last week, and I think a couple of others were there, Harald was there, was at an event with institutional investors. And you have to come, it was the same discussion, it was about mobilization and all that. MDBs were sitting there, and they really live on a different planet. Yeah? And the categories in which they think are just absolutely fundamentally different from the ones that the MDBs think in. And I think one of the results is that since Addis and the big proclamations, we have not seen any change in strategic allocation in these institutional investors. We have some, like CDPQ, for instance, that have gone backward. Yeah? We have some others, the Dutch, that have gone forward. Others, the Brits, the Germans, haven't moved an inch. Yeah? So if you talk to the pension funds. On the insurance side, even less, because they're all regulation constrained, so they can't invest by definition, so to speak. So there has been no movement there, and on the pension side. And this is because I think we haven't really broken into that culture barrier to try to begin to think in terms of the categories here. I think what José was saying was really important. This creation of asset classes is a cultural experiment, I think, okay, in this field.
But I think, following on what Peter was saying, I think what is very important is to move, in terms of building the common language and so forth, is to move from the big slogans, where you say, private investors saying, I have trillions to invest, and MDB saying, but where is the money, to much more concrete discussion, and I think the private sector lab in the World Bank helped, and we are developing, there's something in London to discuss with the private sector, benefiting from the London as a financial center, to really discuss concretely what is needed, what is the size of investment, what is the kind of risk and so forth, in a very operational manner. And then it's people from Treasury, you need to have people who understand the other's language, but it's moving from the concept and the big narrative to operationally what can be done, and start with testing the ground with new kind of product and so forth. I think that's very important.
Thank you. So let's, I think this will end up being the final question actually, but the question on how do we actually push organisations to adopt transparency when they may feel that there are sort of competitive or other commercial reasons not to, or in the case of development banks, maybe other sort of political reasons not to adopt transparency. How can we push that transparency agenda?
Well, there was a hint about AI. I think like in terms of transparency, contracts, taxonomies, transparency in a number of assets that are going to be sort of part of the discussion here and the construction of this asset class. I think, for example, the BIS has a Gaia project that sort of precisely tries to homogenize the taxonomy of a number of green financial instruments. So this is, I think, a progressive way in which you're going to be reducing uncertainty about these financial vehicles. You're going to be reducing and homogenizing the type of instruments that you're going to be sort of putting into the market. These are sort of forces that will favor precisely the trend that we are discussing here.
No, I think for us the anonymity of data is very important. So if you don't want the individual clients to be identified and so forth, and then the obstacle that we had with GEMS is if in some countries you have a very limited number of transactions and one is defaulting and so forth, then it's very easy to identify which is it. So that's the limit, but otherwise as soon as we can preserve the anonymity of the clients, individual clients, I think that's, there is no limitation. But then, of course, you need to have the methodology clearly agreed on what is how you measure concessionality and so forth.
Well, thank you so much. I mean, that was such a dynamic panel. Fantastic contributions. Thank you very much for that.